Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So, interest rates tend to be higher, or the thought that interest rates will go higher will tend to pull in hot money. Economic growth is also the other major fundamental driver you can hang your hat on. Economic growth is that stuff that says, hey, this country looks like it's going to grow over time much faster than another, therefore I want to have access to that economic growth, which means you're thinking of a long-term view. This is long-term portfolio flow type stuff. This is the stuff, I want to get a major portfolio access to the stock market. This FDI, or foreign direct investment, was a big, powerful driver of the dollar in the 1990s. Remember that dollar bull market that I showed you? People were moving a lot of foreign direct investment in the U.S. to get positioned for that big tech move in the U.S. The growth in the stock market was a biggie. The looking for major capital gains relative to other places around the world was a big driver. So those really are the two drivers fundamentally. And all the stuff that we do in terms of jobs, industrial production, and everything else really goes to trying to define these two major drivers of currencies that have always been something you can hang your hat on. The second part is sentiment. Again, sentiment is important to understand. Again, not that you have to be an expert and you have to get in there and say, hey, I know every little piece of data out there. It can really be as simple as just watching the market and just seeing how everybody shapes up and talks about it. And you can find survey data on this. We all knew when the euro was heading, well, at least, well, we didn't know, but at least we all, those of us that weren't perma bears on the dollar, watch the silly stuff start to happen when the euro was around 160. The supermodels only wanted to take payment in euros, and then we had the rappers wanted to take it in euros, and the euro was going to replace the U.S. dollar next year as the world reserve currency. It was just turned into silly season. So. And then of course all the magazine covers that the dollar is dead, la la la. So you see that on major sentiment extremes. You see that in every market, and you see it more so in currency markets, and that was a perfect example then. Another way to look at this quantitatively, we use one very simple indicator, and it's open interest data, and I'll show you how to do that in one of the upcoming slides. It's just a thumbnail snapshot qualitative measure of sentiment in currency markets. And again, it's been useful over time, especially during major long-term trend changes. This is the stuff that leads to overshoot, okay? This is the stuff that drives that self-feeding aspect of currency markets. I guess, as important as fundamentals are, as important as your technical analysis is, given what we've watched over time, if you just understood sentiment alone and had a real good qualitative understanding of sentiment and some type of quantitative measure on a consistent basis, that really is the best driver of currency markets, because sentiment in and of itself embodies all this other analysis people do, and they make a sentiment decision, and their expectations are all embodied in sentiment. And expectations about the future is what moves people to move real money. So of all these buckets, sentiment is the most nebulous one, but yet sentiment in and of itself incorporates those other two alone. So that really is an important one. And don't underestimate just your qualitative objective analysis of the market. It can be a very, very powerful event. Simple example. Say we see a major report out, and it's I'm talking something one of the most key jobs report of the year is coming out, and it's very, very negative for the dollar. And at that point in time, people would expect, hey, if the jobs report is this bad, the dollar is going to crater in this trend, and it's going to never come back. Well, sure enough, the report comes out, and right away the knee-jerk is the dollar sells off in a big way, but starts to drift back, and closes higher. That's what's called really adverse reaction to the news. In this case, this major deep sentiment suggested the dollar would sell off on this news. It didn't. that tells you something. That's a piece of qualitative information right there that you can grab a hold of. Then you start using your technical analysis and you think about some of your fundamentals and you say, this may be the point of a major trend change. Often you see that. A major news event that's going to change the course of the dollar or another currency for months to come. It comes out in the way everybody expected, but the currency doesn't react as everybody expected. It's telling you something right there. Something's changed underneath the surface. So don't underestimate the easy qualitative aspect of this and the power of it. Technical. We do our trend analysis. We do our price action analysis. But in terms of the long-term view, we found the most useful is our intermarket analysis. Why? And what is intermarket? And what am I saying here about intermarket analysis? Comparing the U.S. dollar to the major global asset classes, comparing the U.S. dollar to stocks, comparing the U.S. dollars to bonds, comparing to gold, oil, other commodities. The reason this is important because these other major asset classes in and of themselves help you define global money flow. What's hot and what's not. So when you just use these correlations on a long-term basis, intermarket analysis-wise, overlay charts, watching the reaction of the dollar relative to these other asset classes, and you step back and you do it on a long-term basis, we found it's the best way to really help define the long-term trend or changes in the long-term trend, and I'll show you some examples and charts. The reason this works, this intermarket analysis of the major asset classes against the U.S. dollar is the world reserve currency. As I said earlier, the U.S. dollar funds these other asset classes around the world. Global markets are highly correlated and have gotten more highly correlated because of globalization. Globalization has tied markets more closely together. So the independence is declining around the world in all markets. And what's the big dog that drives all markets? Of course, the U.S. And the U.S. dollar is what links it all together globally because it is the world reserve currency. That's why this intermarket analysis stuff works. It's not rocket science. It looks very simple, but it puts you in the ballpark. It puts you in the ballpark of success to trade with a trend. And it's so simple. You can identify trend changes, or at least you can not, again, without hindsight, you don't know it's a trend change, but you can see things start to change before the guys on CNBC that are analyzing line 3 of the GNP report talk about them by just using your simple view of the dollar against major asset classes. And I'll show you some key examples of what we use on a long-term basis. So again, there's the framework. It applies in all time frames, and especially to us is important in the longer-term time frame.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.